Are you torn between investing in dividend stocks or index funds, wondering which strategy will give you the best return on investment? In this video, we'll do a side-by-side comparison of dividend investing and index funds to help you make an informed decision and optimize your portfolio for long-term gains. So sit back, relax, and let's dive into the world of investing. If you're a beginner investor and haven't yet started to invest, you can open your first brokerage account with Acorns and start your journey today. Click the first link in the description to know more. Now on with the video. When it comes to investing, there are two schools of thought: dividend investing and index investing. Advocates of each approach will tell you theirs is the superior way to invest, but both have their merits. In this video, we'll compare the two strategies so you can make an informed decision about which one is right for you. Don't forget to subscribe to our channel and hit the notification bell to watch our latest videos as soon as they are released. If you're a buy and hold investor, dividend investing can be an incredibly cost-effective way to invest. In fact, in larger portfolios, it can be cheaper than index investing since there are no management fees. But when it comes to investing in individual stocks versus funds, there's always a trade-off between focus and diversification. Index investing offers cheap access to a broad range of diversification, while investors who choose individual stocks concentrate on their best ideas. This approach can lead to poor results for some, but better than average results for those who are better than average. And while it's not easy to find favorable investments, it's not impossible either. It just takes a lot of time and effort. Comment stocks if you would like us to make more videos like this in the future. Index investing is an excellent option for those who aren't interested in learning too much about the market. While some people are passionate about investing, others may not be, and that's okay. The simplicity of an index strategy is one of its biggest advantages. It requires little time and research to implement. Warren Buffett even recommends a simple index fund strategy: 90% in a low-cost S&P 500 fund and 10% in a short-term government bond fund. This portfolio would have an annual expense ratio of just 0.10%, making it an extremely cost-effective option. Of course, you could spend a lot of time researching and perfecting your index investing strategy, but the beauty of index investing is that you don't have to. It's the most time-effective investment strategy out there. Don't forget to like this video if you've watched it till now, as it inspires us to make content like this. Now let us compare dividend investment and index investing head-to-head to give you a clear picture of which one is best for you. Number 4. Time. When it comes to the amount of time it takes to invest, index investing is the clear winner. Unlike dividend investors who need to periodically check in with the businesses in which they've invested, index investors don't have to keep up with individual stocks. While dividend investors need to make sure the companies they've invested in still have a strong and durable competitive advantage, index investors can sit back and relax, knowing they're invested in a broad range of companies that are likely to perform well over time. This is one of the biggest advantages of index investing and why it's such a popular strategy among those who want a hands-off approach to investing. Number 3. Costs. When it comes to cost, it's not as clear-cut whether index investing or dividend investing is cheaper. While dividend stocks don't have expense ratios associated with them once you own them, they are taxed, just like many funds that pay dividends. However, holding your dividend stocks in a Roth IRA can eliminate this disadvantage. In terms of comparing the costs of index funds and dividend stocks, the math shows that for a long-term buy and hold investor, dividend investing is likely cheaper. For example, investing $100,000 in the low-cost Buffett fund would cost $96 every year, while investing $100,000 in 30 dividend stocks at $7 transaction costs would only cost $110 one time. After 3 years, the buy and hold investor would have paid less in fees. Over the investor's lifetime, they would pay far less in fees with dividend investing, which is why it's important to keep portfolio turnover to a minimum. Overall, the cost advantage goes to dividend investing, but just by a hair. The decision on which strategy to use ultimately depends on how you invest and your individual circumstances. Number 2. Returns. In terms of return data, there is evidence to suggest that investing in individual dividend stocks with specific characteristics can lead to solid long-term returns. These characteristics include a lower than market average price-to-earnings ratio, higher than average market dividend yields, and strong competitive advantages. For example, let's say an investor identified a dividend stock with a price-to-earnings ratio of 15, a dividend yield of 4%, and a competitive advantage such as a strong brand name or patent protection. This stock may have the potential for solid long-term returns if held in a diversified portfolio of similar dividend stocks. When we say solid returns, we mean there is a good chance that the total returns will be a few percentage points above the overall market. Of course, investors should not expect 30% a year returns or anything of that nature. On the other hand, index investors can also invest in value or dividend funds. These funds attempt to take advantage of specific factors that have historically resulted in greater long-term returns. However, the more these funds try to target specific factors, the more they tend to charge in fees. And finally, number 1, risk and psychology. Investing in individual businesses can provide a better understanding of the underlying business during recessions. For example, owning shares in PepsiCo during a recession may be easier to hold because people will keep buying their products. Dividend investors tend to watch dividend payments instead of share prices, which are less volatile. Selling shares rarely and only when significantly overvalued is a good strategy. On the other hand, index investing offers a highly diversified portfolio that can be easier to hold during recessions. The portfolio may also include government bonds and gold funds, which have a low correlation with equities, reducing portfolio-level maximum drawdown. Overall, the edge goes to index investing due to its lower portfolio standard deviation. While dividend investing and index investing may seem like two opposing investment strategies, they both have their own advantages and can work well for different types of investors. Ultimately, what you value as an investor will determine which strategy is the better choice for you. Having a solid investment plan and sticking to it is more important than getting caught up in the debate between dividend and index investing. Investors looking for less risk and less time spent analyzing financial info should consider index investing, while those who want more customization and are willing to spend more time learning about individual businesses may find dividend investing to be a better fit. So that's it today for you guys. And don't forget to check out Acorns by clicking the first link in the description. Thanks all. Bye.